my colleagues and I would be very happy to answer your questions.
Matt, could you briefly discuss the Prop 30 impact here? I know you said it some, but just kind of in a conceptual term. There was a long fear that once those taxes went away, the structural deficit would return, all the underlying problems we've been dealing with. You're not seeing that at all.
No, and again, it's for those two reasons. Because the sales tax, again, the sales tax rates are levied on a calendar year basis. We're on a fiscal year basis. So the sales tax rates kick off first, that $0.25, and the effect of that is felt over 2 years. And then after that occurs, the PIT rates kick off on a calendar year basis. So you have 2 fiscal years over which the revenues decline. So if you look at our revenue estimates of what they're growing at the end of the period, it's at a fairly low rate, John. It's like averaging about 2%. So you do avoid that big cliff effect because of the way that the tax rates phase out. And you have to look at revenues to see more the effect of even the revenues falling off. Because we're looking at the operating surpluses, other trends that I've talked about help mask that effect of having revenues phasing down slowly. And that's primarily that property tax effect I mentioned. General fund spending is relatively flat. That creates added room that tends to offset the effect of lower revenues in those years.
Can I just follow? But it's important to note, I mean, for those of us who've sat here for a very long time talking about structural deficits, you say here, the structural deficit's gone.
Yes. Now, again, people are going to define structural deficit differently, right? If you're going to include in your calculations, you need to be paying off unfunded liabilities within a 10-year period. These numbers would look very differently. Because we have not statutorily or as a practice included monies to pay off CalSTRS, retiree health, those aren't in our baseline numbers that are reflected in those operating surpluses. So someone could have a different view of what should go into those basic calculations, and the numbers would look differently. We've tried to address it, John, through acknowledging that we should start setting aside money. But the way that we've done the calculations based on our historical practice, the operating surpluses are gone.
But if we don't start paying down the debts and we don't build this reserve like you're suggesting, we will have the cliff when these 2 taxes go away because we will not have that cushion, or am I mistaken?
Well, again, it's hard because you've got different things floating around here, the decisions that you might make. What we're saying is the cliff effect isn't really there in part because it's phased out over 4 years. You were not going to see a dramatic cliff effect. Let's call it a step-down effect. And that means not that all of a sudden revenues decline, it's just that the growth rate would step down. Instead of growing at 5% a year, you might grow at 4, and then 4, and then instead of growing at 5% when the PIT rates go off, maybe now you're growing at 2 and 2. So you don't have the sort of dramatic cliff effect of people thinking you go from 120 billion in that out year to 100 billion. Maybe you go from 120 and you're going to grow to 125, you go to 121. So you would not have had a large cliff effect if you look at revenues. Countering that, though, are these other factors with the property tax growth that tends to offset it, and that's why you're not seeing it.
But if we don't have the growth?
If you don't have the growth because of an economic slowdown, those numbers are going to look differently. Let me go back here first.
Thanks. You mentioned the property tax growth
yes.
that's included in these projections. Why are you expecting such a growth in those property taxes?
Well, 2 basic reasons. I mean, first of all, we've had very low property tax growth rate given the sort of housing problems that we've had. Sales have now picked up dramatically. Home prices are much higher. They're on average 25% or more since in the last 18 months. So now when you have sales, you have property values that have grown, you get more revenue. We also project that building will resume in the next few years and get back up to more traditional levels. Multifamily, single-family homes. When you have that growth, you get a nice bump because you've got all this new value that you capture right away. So like I say, we're forecasting sort of underlying property tax revenue growth of around 7%, which is fairly normal by historical standards, but we haven't seen those for a long time.
Have you factored into that property tax?
I'm sorry, Dan, what?
Have you factored into the property taxes the effect of what seems to be a sharply lower population growth in California, presumably reducing the demand for housing?
Yes, I mean, we've tried to do that through our demographics and through our assumptions about what those home sales would be, Dan, but, you know. So we have much lower population growth, for example, now. It's more in the, I think, 0.7 or 0.8 range.
0.7.
That in the past, it would have been in the 1.2 to 1.5 range. So we have tried to take that into account.
Yeah, it's been a very good year for the markets, obviously, but I think a lot of people think they're artificially inflated right now. I mean, how quickly do your surpluses start to recede, you know, if the market kind of tails out or starts going down in the next year or so?
Well, and we talk about that in the document, that market values we don't think are out of line when we look at various metrics that are judged, price earnings to earnings ratios. It's not out of line like it was in the dot-com boom. And so we did try to take those things into account. We don't forecast it to continue to sort of grow rapidly. In fact, we take the level that the market, say the S&P 500 is at right now or recently, we assume it stays relatively flat for several months and then grows only slowly, less than even the pace of the economy. So we have tried to take that into account. But your question is still a good one, of what if the market does turn down? Interest rates start to rise because the Feds change their monetary policy. The market it depresses. Those can always happen. And that's again why we've given priority towards being careful about the additional commitments you make in the near term and using those monies that we see coming in, those operating surpluses, to give the reserve a very high priority. But it is a good question and one we're concerned about.
Getting back to property taxes, I know talked to some assessors who talked about there would be a slingshot effect coming out of the recession because people were able to get reassessments from their base year values down to much lower rates, and those can come up at the full increase in market value up until it gets back to the base year. Is that part of the growth that
I think
see?
we've tried to incorporate that in our estimates. He's talking about the so-called prop rates, where you went below market value. You don't increase it just 2% until you, Tim said, you get back up to your original assessed value. And so we have tried to build that in. Just one of the more factors that complicate
But do you
trying
see
to...
that as a relatively minor factor in the 7%?
I would say
growth?
so. It is a piece, but yeah, not a crucial factor. You've got all these other things going on with the redevelopment, for example. We're still getting the benefits of the phase-out of redevelopment, where the annual amounts coming in from that are going to continue to grow over the period, too. So that and the triple flip and just underlying growth probably swamp that effect, but it's a piece.
Just more of a general question. Do you see the government growing, adding jobs, I guess, the next several years?
Actually, most of the spending is, if you're talking about state government or just government in general. If you look at our underlying estimates, you have school spending growing, so you could certainly see growth at the local level. But most of the state government is sort of focused in higher education and corrections, and then there's a lot of other. Caltrans is big, but some other agencies that tend to be funded by special funds and federal funds. In higher education, for example, you'll see our forecast is flat over the whole period. That's in part because we don't automatically put an inflation adjustment in because state law says we're kind of not supposed to assume automatic. But the underlying demographics on higher ed are that 18 to 24 college-age going population is actually declining during the period. So we don't see, I mean, we can always grow because we want to take more students, but we don't see great pressures in the higher ed system. Corrections we have growing relatively slowly. That's another large employer at the state level. So I would say our forecast sort of implicitly assumes not incredibly large expansions in the number of state employees.
Mac, in terms of potential spending, it looks like you guys do take into account the prison spending, the $300 million or so
Yes.
in the coming year. But when the budget, when legislative Democrats compromised with the governor last June, I think many of them said, "Look, we're taking these conservative estimates now, but we're not at all, precluding the possibility of mid-year spending increases if the money comes in." What would you say to legislative Democrats today if they say, "Hey, we've got this money. We've said we want to look at restoring programs, maybe even mid-year, maybe next year"? What would you say?
Well, I would say that we have tried to set aside funds for those very purposes, realizing they're going to want to do that. And that's why we've put those categories in our figure 4 sort of approach to thinking about the operating surpluses. It's also important to remember that implicit in our numbers, say if you looked at 14-15 where we show a 3.2 operating surplus, we've already built into our Prop 98 numbers a very large increase in Prop 98 spending. it grows, the general fund share grows by about $6.4 billion. And the amount of money available for ongoing programs is even greater. So there is a large amount of money there for increased program spending. It's just that sort of built into the top line. And then we've tried to build in acknowledging that they may want to give inflation increases to the universities or to the courts, and that they may want to make some new commitments, that we've tried to acknowledge that.
What about mid-year? What about, when
Well,
they come back in January?
Mid-year, they could do that sooner. It would just mean that you would end the year with not a $2.4 billion surplus starting off. You would have a smaller surplus. And since we implicitly give high priority to trying to build up those surpluses, we would hope they would be careful in making too many of those type of additional commitments too soon.
Matt, are we still in the problem where we're overly reliant in the future on PIT? I tried to glance through there to see if you wanted to issue that kind of warning. And then related, can you talk about Twitter, Facebook corresponding, how Facebook did and it bounced back, and whether you think the same concerns arise over Twitter and PIT?
Yeah, I'm going to have Jason help me out on the Twitter, because we didn't make a specific adjustment to our numbers as we did for Facebook. It's not near the magnitude, and we always assume some IPO activity. Now, Twitter clearly, as a California-based company, is an important one, and it could mean there's a little bit of even downside bias because we don't have a specific assumption. But we do always assume a certain amount of IPO activity. But on your first point, which is a really good one, the personal income tax now is responsible for 2/3 of our general fund. That's dramatically different from 30 years ago when it was probably 1/3. And it's not necessarily bad that the personal income tax is 2/3. It's a robust tax, and people like it. It's used throughout the country and at the federal level. It's just that if you're going to be heavily reliant on it, you have to constantly be reminded of that volatility that's implicit in relying on a tax, that at the margin, capital gains can change very dramatically. And when capital gains change, when the markets downturn, the first question, or earlier question we had, you're talking about people who have lots of control over when they realize gains. You're talking about people taxed at very high rates, so you're not losing, 5% or 6% on that dollar. You're losing 12 or 13% on that dollar. So if you're going to be heavily reliant on personal income taxes, what it suggests to us is you have to have very strong reserve practices. And secondly, you have to be very careful when you're coming out of a recession and things are improving, not to overcommit on spending to ongoing programs. And that's another sort of, if I didn't sort of reflect that when I was talking about Figure 4, again, that's why we try to rely more heavily on the one-time things early on. And that if you are going to make additional commitments that are ongoing in nature, and if you look at that chart, the last three categories are ongoing, you'll see that we build them up more slowly and incrementally, such that if 2 years out, we're seeing that our revenue estimates aren't accurate, or that the market has a minor downturn and we have a lot less money, you're in a much better position to adjust to that changing revenue. So it's a caution, Michael, that we try to, I think they're heavily throughout here, those cautions, and we try to remind the legislature of the uncertainty, the volatility surrounding our revenue numbers.
Do you factor in any of the so-called migration of multimillionaires out of state?
Not explicitly.
Or do you not see that at all happening?
Well, we're not seeing it in a way that we can quantify. We certainly know anecdotally, and that just from sort of logic would dictate that some people are changing their behavior. Maybe they're not expanding here. Maybe there's people that didn't come here now because of our temporarily high rates, that maybe they'll come in 1920 when if the rates go back down to the 9.3 level. We know that maybe some people, when they retire several years from now, will decide not to pay their higher taxes in California. They'll go someplace else. So we know at the margin some of that is happening, but it's not of such a nature right now that we can quantify or explicitly account for in our forecast.
Matt, can you talk, on those same lines, it looks like corporation tax revenue kind of stands out from some of the others in terms of it actually going down.
Yeah, corporation taxes, because of all of the things that we've done to it in prior years with net operating losses, credit sharing, the research credit, it's very difficult to forecast. And frankly, we don't have a great handle on it. We try to acknowledge that in the write-up. We do expect, taxes to do better over the future as maybe some of those effects from the tax changes sort of play out But the tax has not been doing well in recent times.
Mac, the speaker towards the end of last year, and then certainly said he wants to come back to it this year, this idea of establishing his idea of a rainy day fund, which is based on capturing excess capital gains revenues. In your view, would that approach help reach the level of budget reserve that you're talking about?
I think the speaker's approach is very similar to ACA 4, which is scheduled to be on the ballot, and it's trying to do the right things of, one, taking money off the table during good times. The speaker does it by driving off capital gains in excess of a certain amount. ACA 4 does it in a little different way. And then building up your reserves. So both approaches, in principle, I think are great. It's exactly what we should be doing in practice. Technically, does it work? Because capital gains income we don't know about till 2 years after the fact. I think the issues we have are more of a technical nature if you can make it work. In concept, though, it's exactly the right approach of realizing what your volatile revenue sources are, and when you have higher than average, trying to take that money off the table.
Mac, is this the first year in recent years that this outlook has shown a surplus or sees a surplus coming?
No, I think last November we showed, Jason, help me, I'd have to...
At least for the out years.
For the out years, we may have had them in near term, but we showed those surplus. And we showed the same trend, and then if you go back in May, you'll see almost exactly the same pattern. It just steps up a little bit faster, and then we showed 3 more years. But no, it's really not that much different from where we were in May.
To put this in perspective, kind of big picture, where California has been, how far it's come, where it might go.
Well, clearly from going to deficits that were in the $10 and $20 billion range, the sort of sea of red that we used to show you, to these sort of operating surpluses over the period is a significant downturn. And again, it's for a variety of reasons. We finally have an economic recovery, the best way to grow yourself out of problems. We had Proposition 30, which has provided, obviously, relief in additional revenues, even though some of that does go to Proposition 98 spending. And all of the efforts that the legislature took during the bad years of slowing the growth in many programs, or in some cases taking reductions in programs, whether it's CalWORKs grant levels or other things like that, clearly also helped put us in the position now where we can look at operating surpluses.
Could you offer just a bit of context about the decisions that had to be made over the last decade to address some of the problems? The reason I ask the question is the Prop 57 bonds are a great example. It will have taken us more than a decade to pay them off.
Yes.
And so this forecast seems to be the final chapter in some of the solutions that we had to go through to deal with some of the problems.
Well, you can see that when you do something you shouldn't do, like paying for operating expenses with bonds, with financing, debt financing, it has repercussions over many, many years. And it's something you want to try to avoid in the future at all costs. Because we've had to dedicate, $1.6 billion to pay off debt service on those bonds that could have been used for other purposes. Similarly, we have special fund loans and the deferrals and all of these things that we need to pay off. And our goal should be not to use them again, not to think of them as sort of a reserve we can dip into. We know that some of them will be available, but you don't want to do those type of things because it does create a burden on, in effect, the next generation. So I think that's one reason why we do give high priority to build up your reserve so you have a cushion to ease yourself out of a problem, of at least a moderate recession, and pay off those liabilities so that you don't, in effect, have to incur those and put a burden on future generations.
And on the liabilities question, your recommendation under your scenario is a, by my read, not your read, somewhat of a modest paying off of some of the liabilities. For example, the pension stuff, PERS or STIRS, and STIRS, of course, has to get legislative approval. Some would say maybe you need a more aggressive structure to that, and it seems as though through your forecast period, you start off at $500 million. By the time you do it, and you only grow to a fraction. Why so a cautious approach to paying off some of that?
Well, I guess that's one way of looking at it, John. On the other hand,
Right, it's my
our
way, I
current
apologize.
baseline for 1920 is $0 going towards those commitments. We would put $3 billion. So I don't think it's quite as maybe insubstantial as you might suggest from your question. And remember, on CalSTRS, even though I think we're looking at a sort of a $4 billion commitment to amortize its unfunded liability, that doesn't necessarily all have to come from the state. So that maybe if the state has a proportion of those costs, you might be able to meet what even STRS says we need to amortize that, and still have some money left over to pay off some of our other unfunded liabilities. But I'm not challenging your basic. If the legislature wanted to take a more aggressive approach to addressing those, we'd be all for that.
Let me ask you this, Mac, since you raised that question, the STRS thing. Would it be fair to include STRS payments in Proposition 98 since it goes to the system?
You know, that's a real tough question, Dan, because the paying off an unfunded liability is not like a regular operating expense. It can go up and down, and then it can end. So it's not the kind of thing that is well suited for being in a budget that's supposed to be addressing operating expenses. And I think the legislature was probably correct by not including the payment, because at that time it was probably not what we would need to pay. And if you had included it in the 98 guarantee, and then you had to increase it or triple it, double or triple it, that really wouldn't be fair to the rest of the operating budget. So I'm not sure it is a good category. Whether they'll consider it or not, I don't know. But you don't want things that go up and down. It's the same reason we didn't put debt service in.
The governor's kind of indicated, kind of hinted around that he'd kind of like to do something like that, is to isolate expenditures within categories. For example, shifting the service of general obligation bonds for transportation back over into the transportation account rather than having them out of the general fund. It would seem that
well, but that's a different issue, though.
Stuff into 98 would be in that same.
No, I think they're very different. Having transportation pay for its debt service is a policy call that can make sense on its own. But you're trying to sort of change the rules in midstream of, well, it's never been in there, and now you want to put it in there because it's going to be growing rapidly. Those are the kind of things that we've spoken out against, that we think you want to kind of reserve what 98 was intended to do.
But isn't the effect of that leaving it out, as well as leaving out the debt service on general obligation bonds that go to the schools, does it not understate the amount of spending that the state is actually undertaking on behalf of students? Because the per pupil spending is usually calculated on just basically what Proposition 98.
Oh, sure. I mean, Dan, I think in an ideal world, if we had a stream of capital-related payments going to schools that was fairly steady, it should be in there. And similarly, if we had a fairly consistent stream of payments that the state was making towards the CalSTRS system, it would be appropriate to have them in. But neither one of those are the case.
What's the effect of the Obamacare on the budget and on your projections?
You know, very little, actually. Because we have done the Medi-Cal expansion, the federal government pays for most of that. In the outer years of the period, we do have some effect because we're picking up to 10% of those costs. So they do ramp up, and we have accounted for that. That's the main direct effect of Obamacare on the fiscal forecast.
Mac, how likely do you think it is that the legislature over the next 5 years would follow a program like the one you suggest in Figure 4?
Well, again, we don't think they should follow it exactly. They have to bring their own priorities to it. But certainly in what I've heard from the speaker and from other leaders, they want to give priority to building up a reserve, paying off our budgetary liabilities. I think you have the perspective from the existing leaders who had to go through what they went through in the last 5 years, that they've sort of already passed along to these new members who could be around for the next recession, who can be here for 12 years, that they don't want to put themselves in the situation that they were in 2008 going forward. So, I'm hopeful that we'll make progress in these areas, and I think there's a good probability that we will.
And as a general question, there's so many parts of the budget that experienced difficulties over the last several years, and you'll have legislators looking to you about social services, about the UC, about CSU, about all of these places. What would you tell them about the prioritization of restorations or growth? I mean, I know you talk about it some in here, but there's got to be a larger message here about how you balance that feeling of the need to restore and grow versus all of these other prudent factors.
Well, I'd say, first of all, you don't have to worry about 98 since they have their own funding source. They should be back up to their pre-recession per student spending.
Everything else.
Let's say for the other part, I think that's why a general structure is helpful. Because once you make certain decisions on do you want to build up your reserve over what period, when do you want to pay off the wall of debt, do you want to make commitments of some type to paying off your retirement liabilities, you only have so much money left. And if it's from the leadership and the governor that, look, if this is roughly what we think we have to spend, it just obviously doesn't have to be our numbers, it can be whatever they think is appropriate. If that sets a general framework, John, for, this is the amount of money you have, then you can look at where you've made program cuts over the past, prioritize those, and sort of realize that you have kind of a budget, if you're going to achieve these other goals, to work within. And I think that's what this sort of general approach may help you do, of recognizing that you only have so much each year, and you prioritize where you want to make those restorations.
Given that there have been various estimates of the state's unfunded liabilities, and different groups will make different assumptions to reach different points, rates of return and stuff, what's your best take on how much money the state actually owes in retiree health, STRS, et cetera, and other programs that I might not have just mentioned?
Well, yes, the biggest decision, or the biggest sort of variable, is what is the investment earnings rate. The systems tend to be around 7.5%, and you've had other groups suggest they should be in the sort of risk-free rate, or 4 or 5%, and it makes a huge difference on those liabilities. I think, we feel that the systems that have tried to bring down those investment earnings rates slightly over time was an appropriate thing to do. Over the longer run, we probably would like a little bit more conservative estimates on returns. But I think it's more important that we do just set aside and we start having financing systems for the things that we're now either pay as you go systems like the retiree health, put aside something, have a plan, or CalSTRS reach agreement with school districts and with teachers on what they're going to bear and what the state should bear, and start setting aside money to address those. If you find that your investment earnings aren't matching what they said they would, the system said they would, they should start bringing those down. That will increase the unfunded liabilities, and it just makes it more important that you have money set aside, and it may be that you have to divert a little bit more money to that category as opposed to the others. But that's something that I think you can do over time.
But as far as an estimate, like your estimate of how much
we've gone with the system's estimates, and so it's in the $170 billion range. But there is upside risk of that, clearly.
Mac, I'm not sure I really want to go here, but since you say it could cause you to be off by over $1 billion a year, you talk about this net final payment accrual process. Is that only going backward? I mean, trying to figure out what the 12, 13 revenues were? I mean, is that a going backward issue?
Yeah, I mean
12.
And 11, 12.
Right.
Yeah, I mean the new process for Proposition 30 revenues and other revenue increases enacted after 2012 have a different accrual process. And frankly, it's a bit of a mess now. We have two accrual processes for revenue. And it's not a real transparent process. And it means that you have adjustments that can be made going back a couple of years for a long period of time. You're kind of constantly looking backwards. And what we've called for is just we think it should be transparent as what are those changes that the administration makes to their accrual adjustments.
And to clarify, under the current Budget Act language, that would be an ongoing change for Prop 30, 39, and all future revenue changes adopted, on a similar basis.
Would it also affect new revenues that accrue from previously existing taxes and levies, or would it only include the newly installed?
New levies, and if I recall correctly, it's tied to the initiative process. It's been a while since I looked at the language, but it's kind of geared to Prop 30, Prop 39, and future propositions, I think.
Based on that, you're fairly critical of the report. Is there really then any basis upon which the legislature can make decisions about how much money they're going to have to spend?
Well, I mean, it's at the margin it can be significant because you can move hundreds of millions of dollars around. I think our concern is that when it's not real transparent, it's hard for us to know exactly what our accrual should be. And they're key in determining, for example, the Prop 98 obligations for past years. And so we just think it should be transparent. They should lay out exactly what adjustments they made. We would hope going forward after Prop 30, if those tax rates kick off, we'd like to see the state go back to a simpler, more understandable accrual process.
Matthew, can you comment on the Twitter IPO and what that is?
Yeah, Michael raised that before. We didn't make a specific assumption regarding that IPO, in part because it was very difficult to do the Facebook one. Jason and his colleagues spent a lot of time, and it was very difficult to know because you're trying to judge when people are going to sort of cash out on their options and their stocks. The Twitter is, while very large, it's nowhere near as large as Facebook, and so we just didn't make specific adjustments. As I said,
as far as tech goes generally, I mean, there are going to be more major tech developments in this state,
and that's why
drive the economy.
That's why we always have an assumption implicit that there is that type of IPO activity. We may be understating it, and as I said earlier, to the extent that we are, there's a little bit more upside in that case to our numbers.
So if I read this right, I mean, there's been not much of an impact from some of the mess back in Washington with the shutdown and the sequestration and
Very, very little so far. And absent a big blow up in, early next year, either over the government shutdown or the debt ceiling is the one that we worry most about, because that can disrupt the economy in general. We don't factor in any really large, significant effect from that. We assume that they will address the problems. Anything else?
Thanks, Matt.
Thank you.
Matt.